We start today's market talk. The pace at which developments in the technology are occurring is unlike anything we have seen before. So the major issue which is impacting the markets is right now is AI, which was impacting throughout week, uh, uh, the week which is gone by. Now, what is all these AI models are basically search engines capable of synthesizing data and reasoning from it. This is what we are as a humans are also supposed to do. Basically, synthesize data and take out good conclusions and way forward from it. So, is AI's way of growing, learning, and thinking really different from what is art's way of growing from it? It is not. But demand for AI is already there and is growing rapidly. So the big question is that is AI a bubble? It has potential to vastly alter the business world and change things as we know it. The investment question is whether the magnitude of spending on AI infra excessive or not. Now, some AI revenue is circular right now in the US, derived from AI companies buying from each other. So finally, the revenue has to come from end users for real economic value. So the people have to start using the products and not that they are buying from each other and investing in each other. So right now that real value is not there, and that's why people are calling it a bubble. Startups and small businesses which have been assigned very high valuation without reliable products are like lottery tickets right now. Some people will make money, but more people will lose money. Like we had a recent listing. It's a normal company, fractal analysis, analytics. It doesn't do much in terms of AI, but it was touted as a AI startup, etc. So AI's potential is underestimated today rather than overestimated, but AI investments are not fairly priced. So this is my point of view. In terms of vulnerability, oblique performance, the biggest vulnerable stocks are IT services, which are relying on commodity coding and manual testing. Their business models are disrupted in a big way. So you will see over a period of time, big amount of earnings may remain at this level, but the valuations will come down. So contraction will take place. Then IT products, those who make IT products, for those focused on high-end digital engineering and R&D, AI is a good tool, so it will reduce their cost. So one has to watch what is the management commentary from those companies. Then things like companies like Reliance, they are building gigawatt scale AI data centers, and I think they sold 30% stake in their AI artificial intelligence wing to Meta also. So they should do well. Similarly, L&T. Then things like NetWeb making high-end AI servers and supercomputing hardware. So they should also benefit. Then pharma. It will benefit because it will reduce their R&D timelines. Right now, till now, Indian pharma was more relying on generics, etc. But now it will change the whole thing. So the drug discovery, the process will reduce. Then hospitals, they will benefit because diagnostics will become easier, faster, etc. Banks will benefit because it will reduce their operational cost and the risk management will be much better. So now coming to market outlook. Now this week started with US Supreme Court striking down Trump's sweeping reciprocal tariffs imposed under the International Emergency Economic Powers Act. So Trump had used this in IEEPA Act to impose tariffs. The court ruling struck these down. So then he replaced it with 10% and then with 15%, but that is valid for 150 days, requiring further authorization by Congress. So now probably they will start imposing countrywide specific measures under the Section 301. But that thing about overnight imposition of tariffs where people watch Truth Social for some new informations are over now. So there would be more stability and less volatility on this aspect. Now, selling in IT stocks due to concerns about AI related disruption. As we have discussed, AI is shrinking the traditional service revenues and increasing business risks for the Indian IT companies, and that is what is reflected in the price also. Industry is moving to outcome based hybrid models and not based on how much of work hours and how much of engineers you have put on a job. uh, these companies are benefiting from AI on terms of cost side, but yet to capture the value on the revenue side. So till the time there is a clear revenue stream for them, which is based on good margins, the stocks will just keep going down. At current prices, IT stocks offer more downside than upside. Now let's see the IT Nifty IT index. So if you see here, this is the weekly chart. It dropped from 40,000 to 30,000 within 1 month. See, there are four candles, just dropped 25% in 1 month, right? And this is the support. So first support is somewhere around 31,500. That has got breached. So it is halting somewhere there right now. And in case there are some more triggers, then it may test the lows around 26,000. So one has to watch for this. It is oversold, so there is some bounce, but you may see some rise or some rally, and then again it will go down because the basic thought process behind investing in IT services and their business models are now disrupted. Next is we came up with a new GDP series. It indicates that the economy is slightly smaller, investment is weaker, and manufacturing footprint is narrow. What it has shown is that the role of government consumption is much higher than what was expected, raises questions about private demand and private capital doing their bit to, for the economy. A contribution of agriculture is around 5.8% of the gross value added GVA, and it employs two-fifths of the population. Hence, most of the population of the country remains poor. And now this data is clearly indicated. It also shows that the nominal GDP growth is around below 10%. Hence, hence it has no impact on the corporate earnings because their earnings will also get impacted. And that is the reason why, one of the reasons why the markets sold off on Friday. Now, the recent issue, US attack on Iran may unsettle the Middle East and shoot oil prices up. Outright war will result in hike in oil prices, affecting global economy because 20% of the world's oil transit through Strait of Hormuz. So let's see how it plays out. But right now the situation looks slightly grim. But let's see if there is a deal between US and Iran, etc. Now coming to FIDI data. So if you see here, FIs are they have added index future shorts, sold sold calls, and bought puts in index options, and they also sold in cash. So they are strongly bearish. Coming to pros, they are net short on index futures. They sold calls and bought puts on index option. So they are somehow kind of medium terms bearish. Clients, they are net long in index futures. They have bought calls and they have sold puts in index options. And now this moment, this it reaches 6 lakhs positions in index options, put options, then the worry starts. So because now the movement starts becoming volatile from here because now they are on extreme positions. So they are strongly bullish while DIs have been buying in cash. So if you see here, all the big dip days are the ones where the FIs have turned bearish. So generally the pattern is if you see 3 4 days the market is taken up and the narrative is given that FIs have turned and they are coming back into the country, etc. And then one swift moment we are brought down. But if you really see, we are making lower lows on all. There was a gap of 3 4 days, it was brought down. Again there was a gap of 3 4 days, it was brought down. So, and on those days, like if you see here, bearish, they bought calls and they sold index futures positions. So they were short on the index futures. So these are the days where the more than 1% movement is taking place. Now coming to US markets, this is very interesting. So if you see here, US government bond yields, the 10-year yield, this is a weekly chart. It broke this converging triangle pattern uh, on last week on Friday. Basically, it has come down below 4%. Now, why it is coming down below 4% is basically because it is indicating deflation. Though producers price index inflation was higher, but because of lot of other risks and lot of other problems in the US, and so the market is expecting a kind of a deflation or a recession in the US, and it has started pricing that in. That too. So what it is pricing in is basically two rate cuts in 2026. Now, dollar index, if you see here, it is on a downward trajectory. So it is going down. Now, from the lower levels, it has tried to go up, but it has to go above this 97, 98 level for any uptick. So we have to see this. But it remains right now range bound between 96 and 98. Now, if this dollar index goes up, then the commodities will sell off, including gold and silver. So we have to watch this. Now, Brent crude is on a predictably, there is a war premium attached. It's on an upward trajectory. So from 60, it has gone to 73, and it will just keep moving up until the issue is resolved. Gold, again, same similar issue, hedge against instability and Middle East conflict, etc. Again, it's on an upward trajectory. May try to go up. We may see the previous high of 5,500 also, and but it is slightly overbought right now, so one has to be careful. Similarly, silver, uh, though it has not reached the previous high, but it is again started moving up. It took support at $70 level. So from there, it has started moving up after the big correction. So let's see what happens. Copper is on a strong uptrend, and it has broken the rising trend line. This is due to scarcity and operational challenges because some Chilean mines have been closed, etc. So right now the copper is in good momentum. Bitcoin has declined. It is behaving like high beta technology stock or US tech stock, and it has declined. And now it is at that six. It touched the 60 level, then bounced back, but then it has corrected again. It is below the level when Trump took office. So after that, when he had taken office, there was a big rally. After that, it has corrected. US indices, you see it, they made a high and now they have started correcting. So once they break this 20 EMA, then we will see more downside. Similarly with S&P 500, it has declined from that 7,000 level, and Dow also, they are declining right now. So we'll have to see what happens here. So what is actually happening is there is a rotation from growth to growth stocks or growth assets like Bitcoin, etc., to hard assets like metals, etc., due to geopolitical concerns. Now, so US indices we have seen they close lower, as also the reason was that Nvidia stocks corrected. It came under pressure following earnings and guidance. The point is that the market is saying that these are peak earnings, because this is the peak in terms of investment or capex in terms of the AI stocks. And the US producer price index, which I spoke about, was higher than expectation. It was 0.5% higher month on month. And despite that, the bond yields are lower due to, also could be also because whenever there is a geopolitical issue, there is higher demand for US bonds. Now coming to India, now India VIX actually came down last week, but then again it rose on Friday. So the thing to see here is this 14 level, above 14, 15 level, then the market sells off if it goes to 18, 19. So Along with Nifty, you have to see the VIX also. If the VIX goes up, then the indexes are also sell off. Now coming to Nifty on the weekly chart, see it made a big red engulfing candle. So this is big bearish last week. It declined about 1.5% last week, so which was bit negative. And so if you really see here, the the gap which it created, I'll show you in the next one. See the gap which was created due to the trade deal news from the lows of 25,100, that has got filled. The other point is that based on this good news also, Nifty couldn't take out the previous high. So that shows weakness, and after that, it has been in a declining channel. So it goes up and it comes down. And this week, if you see, it went up on the US Supreme Court news and then has sold off all 4 days, and now has nearly filled this gap. So if you see here, the first line of support is this, and it is below now 200 EMA on the daily time frame. So the first line of support is 25,100. Below this, somewhere around 24,600 should be, or 24,800, 24,600 should be the next line of support. After that, we will see what happens. Nifty Bank, it had a red candle, but it could really go down. So it is relatively stronger. Even in RSI is also strong at around 61 in terms of weekly charts. On daily charts, it has broken the 20 EMA. So now it is looking weak because a lot of money had moved from IT to banks. So now maybe in case it starts shifting to IT back, then because of geopolitical concerns, etc., so then it should go down. So one has to watch this, but it is relatively better. The leader in banks was PSU banks. So the private banks are selling off, but the PSU banks are going up. They made a fresh high, and they are moving higher because of relative comfort with the valuation. But it is now, so if you see, sorry, if you see, it is oversold. So some correction is overbought, sorry. So some correction is due. Now, the reason for fall was also HDFC Bank. It has fallen around 2.6% last week. It's below uh, the 100 EMA on the weekly charts. It is moving lower. One of the reasons is that index rebalancing will finish off in March. So there is and if you see, volumes have been high for the last around 2 months or so. So there is selling, which is funds and etc. are selling slowly. They are selling the HDFC Bank stock, and it is moving down. I think it should finish this week, and the support should come at around maybe 840, 860 at this level. But that should be a good opportunity. Similarly, Reliance, it is weak now, and it is basically used in case FI sell, they sell this, so to bring the market down. So it is at critical level. So maybe around 1360 is one support. If that breaks, then the 200 EMA comes into play. Now, one stock which has declined is Infosys. It has come to the support at 1300, where again last time it took support. So it has come down swiftly to that level. Now the next line of support is somewhere around 1200. That should provide decent support, and it has come down on large volume. So, and it is slightly oversold. So we'll have to see. There may be some bounce, and after that again the decline will start. Now midcaps have also declined, but still they are above the breakout level, so it's relatively stronger. Small caps are also though below, but below the 20 EMA on the weekly chart, but still it's okay, nothing wrong. Now I'll cover two stocks. First is Navin Fluorine. In last quarter, the specialty chemical segment grew by 60%, and the CDMO, contract development and manufacturing segment, expanded by 61%. In February 26, the company commenced commercial production at its new 450 crore AHF and anhydrous hydrofluoric acid plant in Dahej. Rupees 311.5 crore expansion for HFC hydrochlorocarbon capacity and debottlenecking at Dahej multi-purpose plant is to meet the rising HVAC demand. HVAC is heating, ventilation, and air conditioning demand. Right? So it is trying to increase that, and debottlenecking is basically trying to reduce the bottlenecks in production line so that the production can be increased. Earning upgrade of 15 to 20% is likely over the next 2 3 quarters due to faster than expected ramp up in CDMO business, enabled by robust sales offtake from multiple US and EU pharma majors, rapid scale up of volume offtake from Project Nectar. Now, Project Nectar is the one where they are focused on backward integration and high value agrochemical intermediates. Primary driver of 60% year on year growth in specialty chemical segment for them. Then incremental contribution from high margin chemods sales. So what they are doing is they are in a partnership to produce proprietary advanced materials, basically to produce Option. Now Option is a immersion cooling fluid. Now this is very popular because it is used in data centers to cool down the servers, etc. So that's why they are in a good partnership, and that's why there's a lot of excitement with Navin Fluorine. Additional contribution from base specialty chemicals enabled by MPP debottlenecking and high grade AHF sales. MPP is basically their multi-purpose plants at Dahej, Surat for specialty chemicals and CDMO. So that is the reason why they are expected to be a earnings upgrade for them. It aims to reach USD 200 million in CDMO sales by FY30 with a likely short 9 to 12 months capex cycle. For FY27, it is expected to plan around 700 to 800 crore capex. Over FY26 and 28, there could be an incremental 400 to 400 crore EBITDA over the current annual run rate of whatever they are doing. So they should do additional EBITDA. And it is currently a high growth play with strong fundamental backing. Though the stock is expensive, but it's in a high growth phase. So if you see here, they are doing a lot of capex, additional HFC capacity equivalent up to 15,000 MTPA for R32. This is the refrigerant gas. So they are doing capex for that. Then their multi-purpose plants, debottlenecking MPP capacity at Dahej to support launch of new molecules for global innovator, and they are in collaboration to expand footprint in emerging and innovative advanced material products. So again, this is good for them. So if you see here, in the last quarter, their revenues were up 47%. Operating EBITDA, if you see here, it was up around 1,000 basis points. That is nearly 10%. And operating EBITDA was up 109%, nearly doubled, and profit after tax also nearly doubled. Now, if you see here, they have, as I have discussed, they have three segments basically. HPP, high performance products, the refrigerant gases, this thing, uh, fluorochemicals, inorganic fluorides, etc., specialty chemicals, and CDMO. But the major part of the earnings are coming from HPP, and second is specialty chemicals, third is CDMO. But if you see here, over the future, the growth or segment wise revenue contribution is going to increase for specialty chemicals and CDMO part of the business, and that will help the margins. So if you see, it's a very simple stock to see. Expected to do around 23% CAGR revenue sales, EBITDA likely to go up 21%, PAT to go up 26%, and ROE is up. ROE has reached now 20%, so it is expected to be around 20%. So 20, and PAT around 25, 26%. So this is a very good setup. So if you see over FY27, they are expected to do around 25% sales growth. EBITDA margin is going to be maintained. Now it has, in FY25 it used to be around 22%. Now FY26 it has moved to 33%, so that should be maintained. The basic problem with them is they've taken, because of this all this expansion etc., they have a lot of debt, so there is a finance cost, so that has to be watched. Now they are expected to do an EPS of around 171 rupees in FY27 and around 206 rupees in FY28. And it is looking strong. So if you see, with the ROE of 20%, net debt to equity is still reasonable. So the FY27, in case they do 171 rupees, the FY27 PE comes to around 36 times, which is reasonable for stock which is growing at 20% plus uh, every year now, or next 2 3 years. Now, if you see the chart, with the earnings, it went up but corrected. So every dip somewhere closer to this 6,000 odd levels from where actually this breakout took place is a decent opportunity to buy this stock, because it stabilized here for a decent period. Somewhere around close to 6,000, this level is a good buying opportunity. Next stock is Amber Enterprises. Now, RAC industry, that is AC, basically residential AC industry, is witnessing demand revival sequentially, and the company is also expecting growth in the non-RAC segment. Consumer durable supported by mix improvement and scale benefit, expansion beyond room ACs into commercial ACs and non-AC components. Electronic segment is being transformed into an EMS platform covering PCBs, PCBA, HDI PCBs. HDI is high density interconnect technology as they transition to a EMS player. So they are from ACs are moving into making PCBs, so becoming EMS player and industrial automation. The electronic segment has benefited from recent acquisitions with nearly 12% share of electronics revenue coming from acquisition for 9 months FY26. So their acquisitions have been basically Shogini for PCB, Ilgin for global technology, Unitronics for same for HMIs and PCBs, Power One Microsystems for solar inverters, EV chargers, BESS, and Ascent circuits for HDI PCBs, etc. So they are now pivoting to the other segment, which is EMS, and trying to reduce the dependence on the AC part. Electronic segment has benefited from recent acquisition, with 12% share of electronics revenue coming from acquisitions for 9 months FY26. So these acquisitions have helped the revenue, and it has helped the margins. They have reached double digit. Expect full integration of these acquisitions to play out further in FY27. Acquisitions such as Shogini and Unitronics continue to strengthen capabilities across PCBs and PCBA and industrial electronics. It is targeting revenue from railway division to double over the next 2 years, with defense contribution increasing to 20%. They're creating a greenfields at plant for HVAC at Sidwal, for basically for doors, gangways, and pantries for railways. In the machine installation stage, with trial production expected by March 26 and commercial production by April-May 26. In railways, it has done a JV with Eugen Machinery for pantographs, brakes, drive gears, and couplers is ready. So they are now moving into other aspects of railways, with product development ongoing and a commercial production expected to start in H2 FY27 with RDSO approvals. Now, RDSO is a research, design, and standard organization critical for certification required to do business with the railway sector. So, unless you're not RDSO certified, you can't do business with the railways, or you can't be their supplier. It has received approvals from METI under the ECMS scheme. ECMS is basically to electronics component manufacturing scheme. Is basically to help them get the PLI benefit, including Ascent K circuit JV with Korea Circuits for HDI PCB application for rupees 3,200 crore, and Shogini Technoarts for multi-layer PCB application for 500 crore, and for Ascent Circuits multi-layer PCB application. So now if you see the gross sales in last quarter was up 38% and above the estimates. EBITDA was up 55% and margins are higher. PAT was also higher, above estimates by around 23%. So they have done well. They have three segments. So consumer durable is the biggest one, where they supply AC. Then now they're moving into electronics and railways, which are smaller. But the biggest growth, so if you see here, third quarter was 4720. So it has nearly doubled. This is in millions, of 472 crores to 845 crores. So it has nearly doubled now, electronics. And railways is also expected to go up. And margins have improved, and that helped the profits. Uh, Overall, also, pre-ESOP margins have improved. So, Amber is expected to post 21% CAGR of revenue. Non-AC revenue to improve from current levels. So, non-AC revenues are going to come up over the next few years. So, the AC revenues have been declining, and non-AC, which is higher margin, is increasing. So, margins are being held. EBITDA margins are also expected to go up, and PAT margins are also expected to go up along with higher amount of profits. So if you see here for FY27, they are expected to grow around 15%. Electronics division, consumer durable is going at 15, electronics division 36, railways expected to go up around 45-46%. So total revenue is expected to grow up 22%. And margins are helped because of higher margins in the electronics and railways division. And EBITDA margin is expected to go up to 8.4. So if you see here, FY27, we are expecting a total income growth of around 22% and higher margins to around 8.4 and around 483 crore profit. So 483 crore profit at they are at around 28,000 crore market cap. So they are around 55-56 times. So if you see here, they are expected to do an EPS of around 137, which is doubling from FY26. And so they are around 55-56 times next year's earning. And ROE, etc., is improving. So if you see the chart, uh, it dipped because of those AC issues in India and demand, etc., was oversold, but then it rose and now it is slightly overbought. So every dip here, somewhere with this, now in this kind of a problem, if it comes closer to 7,500, etc., is a decent opportunity to get into this stock. I finished. We will take questions now.